This LOS is compare market orders with limit orders. Execution orders. Market and limit orders convey the most common execution instructions. A market order instructs the broker or exchange to obtain the best price immediately available when filling the order. A limit order conveys almost the same instruction, obtain the best price immediately available, but in no event accept a price higher than the specified limit price when buying, or accept a price lower than a specified limit price when selling. Many people mistakenly believe that limit orders specify the prices at which the orders will trade. Although limit orders do often trade at their limit prices, remember that the first instruction is to obtain the best prices available. If better prices are available than the limit price, brokers and exchanges should obtain those prices for their clients. So market orders is for immediate execution, best available price. Limit order is to buy at the limit price or lower. A limit order to sell is to sell at the limit price or higher. Then we can look at stop loss orders and stop buys. A stop loss order is to sell the stock once it goes down to the stop price. So if one board lot trades at the stop price, it becomes a market order. So a trade at the stop price activates a market order. That's very important to understand. Why would we use a stop loss? It means that, let's say we bought a stock at $100 and we want to limit our losses. So we could put a stop loss in for good for a month at $95. If one board lot trades at 95, then our market order, our stop loss will become a market order, okay? And we'll limit our downside risk. A stop buy order is what we do when we've sold short. So we're going to sell high, buy low. So when we sold short, we're worried that the price is going to rise. So a stop buy is going to be placed at a price higher than we sold the stock short for. So again, if I sold the stock at $100, I'll put in a stop buy perhaps at $105. Okay, so if this one board lot trades at $105, I'm going to have a market order to buy it back. I'm going to protect my losses. Okay, we can also have a stop limit order, and that stop triggers a limit order, not a market order. So an easy, quick little review question. A stop buy order is most likely placed when a trader A thinks the stock is overvalued, B wants to limit the loss on a long position, or C wants to limit the loss on a short position. I think that's an easy question. You'd be happy if you saw one like that on the exam. C is correct. Investors who have entered into a short sale will incur losses if the stock begins to increase in value. A stop buy order helps limit the loss on a short position. It becomes valid when the stock price rises above the specified stop price. Now we're going to look at execution instructions, a simplified limit order book. Okay, so we'll start here on the left-hand side, and we'll start with the bid first. So you can see the 26. This is the best bid is at the market. And we have an ask or an offer. The best offer price is 28. Okay, so you can see the spread between the bid and ask is 2. And then you can see lining up behind the best bid is some orders to buy at 25, 24, 23, 22, 21. The prices are going to descend down from the best bid. Okay, and so you can see here these buy orders are behind the market. We also say that they are away from the market. And then back here it says the least aggressively priced buy orders are far from the market. Okay, so then on the offer side, the ask side is just the opposite. The best offer is at the market, that's at 28, and the orders are going to line up behind that at higher prices, 29, 30. Someone is offering to sell at 32 and 33. So these sell orders are also behind the market or away from the market, and the least aggressively priced sell orders are far away from the market. Okay, so again, here's the order prices. The bids on the left-hand side, the offers on the right-hand side, and we have the best offers at the market, the best bid is at the market, then the prices line up behind that. What we don't have here is the order sizes. Later on, we'll look at the same type of grid, but then we'll know how many shares are being offered at each of those prices. So we'll finish this LOS with a practice problem. A market has the following limit orders standing on its book for a particular stock. So we can see there's 5 buyers, 1, 2, 3, 4, 5. And then we have the bid size, the number of shares, and the limit price. And on the seller side, we have the 5 sellers. We have the offer size, the number of shares, and the limit price. Okay, so this is giving us in a table format very similar information that we had on the previous slide with regards to a simplified order book, but this is also giving us the number of shares. So the question is, if a trader submits an immediate or cancel limit buy order for 700 shares at a price of $20.50, the most likely average price the trader would pay is A, $20.35, B, $20.50, or C, $20.58. Okay, this is a good little question. So it's a immediate or cancel buy order for 700 shares at $20.50. I'm going to buy. So I don't need to look, this is just red herring information. I don't need to look at anything on the bid side. I just need to look at what is being offered to me on the sell side. So my limit price is $20.50, okay? So it has to be at $20.50 or better, which is lower than $20.50, not higher, okay? So then I'm going to add up how many shares until 700. You can see I am going to be filled on all my 700 shares. I'm going to get 200 times 20.20, and I'm going to get 300 shares times 20.35. That's 500 shares. And then I'm going to get 200 shares times, at my limit price, $20.50, okay? Then I have to work out the average price. So I'm going to bring up my calculator very quickly, and I'm going to do 200 shares times 20.2, okay? So that's going to give me 4,040. I think I can do this in 90 seconds. Then I'm going to do 300 shares times 20.35. I'm going to write down 6,105. And then finally my 200 shares at $20.50. 200 shares times 20.5. And I'm going to write down 4,100. Okay. I'm going to sum that up. I'm going to have 700 shares. I'm going to divide that by 700 shares. So just bring up the calculator again. I'm going to move it out of the way because that's where I was writing. So 4,100 plus 6,105 plus my 4040. And I'm going to divide by 700 shares. And I'm going to get 20.35. So the correct answer is A, 20.35. So really quite an easy question. You just have to understand how buy orders and sell orders work. This was a immediate or cancel limit buy order for 700 shares. We did get all 700 shares. Now, the way that they could change this question is not to have 700 shares available. So it was immediate or cancel. If we couldn't get all 700 shares, the order would be canceled. Okay, that would be it. So it would be. Again, we wouldn't have this type of solution giving us three prices. So obviously the order was filled because it's giving us three choices. There might be B saying, oh, the order was not filled, But anyhow, very easy to calculate an average. We add up the number of shares times the price we bought it, sum that up and divide by 700 shares. And that's the last slide for this LOS. Thanks.